Shalom, Erev Tov. My Hebrew is not pretty, so I'll speak in English. For those of you who do not understand English very well, I ask a favor. Shake your head like I'm very interesting, so that everyone else pays attention. So I appreciate it very much, Uzi, for the introduction. I wanted to tell you a little bit about myself, and then talk a little bit about the United States. I'm here, by the way, in Israel. Not that I need a reason to be here, but my son made Aliyah a few years ago, so I come to visit him 3, 4, or 5 times a year. And every day, I love coming because not only do I see my son, but every Israeli who I meet tells me how to do my business. So I learn a lot, and hopefully I'll know exactly what I'm doing after you tell me after my presentation. So just a little about me. In addition to my business, I've been the chairman of the board of a major university in the state of Georgia, in Atlanta, called Kennesaw State University, with 25,000 students. And when I took over, it had 11,000 students. Most of them were part-time, and we turned it into a university from a college. And I built about $500 million in real estate over the last decade to expand the campus into a full-fledged university. One of the things I did do was build a football stadium, American football and soccer. We just started football last month, actually. It was one of the fun things to do. I also built 3,500 student housing apartments, so that was a very interesting experience. I'm also on the board of New York Law School, where I got my law degree, and we just built a new high-rise building in Manhattan for part of our campus expansion, which I ran. I'm going to skip down to the bottom first. I am the chairman of a company called Ravco that I formed 18 years ago, and I'll tell you a lot about that. So Chai is a very important year for me, so hopefully it's a good year. The company is in real estate, and we've bought and managed many different types of properties. I'll show you some. Hotels, we've had condominiums, which are selling apartments for sale, house developments, golf courses, and now multifamily or apartments. So I'll talk a lot about that in a minute. As part of what we do, I became very much involved in the Lehman Brothers bankruptcy 4.5 years ago, and Lehman Brothers actually asked us to, in bankruptcy, to become a restructuring officer of a lot of its what we call underperforming real estate that was not being able to pay the mortgage and couldn't needed a lot of capital in order to survive. It wasn't doing well, and that's what helped bring Lehman Brothers down. And my job was to try to fix it. And so I actually managed about $4 billion, probably more, but actually actively developed $4 billion of their real estate portfolio in the last few years. We also were the restructuring officer of a major house developer, and they had $3 billion worth of subdivisions, we call it, in California. So we had about 100,000 acres. How many dunam is that, Uzi? 100,000 acres.
100,000 acres is probably
400,000 dunams in California, and I was the restructuring officer in bankruptcy for that as well. So very interesting last few years for us. So let me tell you about my company back 18 years ago. The first deal that I bought and became part of was this property in Atlanta, the Four Seasons Hotel which is also has an office building in it and condominiums on top, which are apartments for sale. And it was developed by a Swedish developer. He went bankrupt, and everyone asked me, Norman, how did you buy such a magnificent building? I didn't have two shekels to my name. How did you buy something so beautiful? It really is magnificent. And the reason was that the Swedish, the bank went under also. The government of Sweden took over the bank, and they hired a Holocaust survivor who moved to Sweden as a child, and he spoke Swedish, and he now lived in New York. So they hired him as the consultant, and we're the only two Jews in the room, and we made a deal. So I actually made it on a napkin. We just went outside and just wrote up some terms and shook hands, and that's how we made the deal. So then the question was, how does a young man with no money buy a 53-story building? And the answer was, I don't know. I didn't know how to do it. Maybe that's why I was able to. Today, I'd be too scared. But then I went out to look for money, and one of the places I went for money was Lehman Brothers. So Lehman Brothers was really at the beginning of its big growth. There were only 3 people working in real estate for Lehman Brothers. They came down altogether. We went to a bar, and I'll tell you the terms. They gave me $20 million in equity, and the terms were very easy. 9 points, which is a 9% commission, 20% interest, and 20% of the entire deal is what they wanted. So I had no choice, and I accepted, and it ended up being a very, very good deal for all of us. But it made a relationship with me, with Lehman Brothers, which came back later during their bankruptcy, and we became a big part of that because of those relationships. So it was a very successful deal. Later, we sold it to Blackstone, which is one of the biggest, I know you're going to hear about hedge funds later. Blackstone's sort of a hedge fund.
Private equity. Private equity.
Private equity. And I think they merged now. Who's hedge fund, who's private equity. And they bought the deal. So, in fact, today, many Blackstone executives invest with me directly in some of our projects. I'm too small for Blackstone, but not too small for their executives personally. Just some of our projects we've done all over the country. This one here is a 32-story building, condominiums in San Diego, right on off the water, and beautiful views, and absolutely fantastic property. This one, 1,279 condominium units in Los Angeles. We just sold this out 2 weeks ago, so it was a very good project. It was apartments that we converted into for-sale housing, so it's very successful. And this one, you can't tell, is a golf course and beach club community in Naples, Florida, on the west coast of Florida. And it's it's zoned for 1,016 homes. And condominiums. We've built about 680. They're all sold. So it's got tennis clubs, beach club, a bay club, 4 restaurants, and of course the golf course. So also very interesting and successful deal. So we've done all sorts of things: hotels, condominiums, conversions, and all over the country. Florida, San Diego, Los Angeles, and we've done many other places. So. All of that, none of them are apartments. So why am I talking about apartments in the United States today? Because that's where all the action is. The first capital that came back in the United States in real estate looked for property that had been reduced in value, was a discount, but also had 2 other features to it that were very important. That operating results, things were getting better, more people wanted to rent, so they looked for that, and they also knew that there was liquidity. You could get debt. It's very hard today to get debt in retail. It's very hard to get debt in office or industrial, but it is much easier to get debt in multifamily. Why? because the government stands behind multifamily. So the government is actually providing a lot of money and resources for banks and to people buying or building apartments. And the reason is very good reason. 10 million Americans lost their homes in the last 5 years, and more are still underwater. Those people cannot buy a home again because they have bankruptcy or foreclosure on their credit. Shake your heads, remember, if you don't understand me. And so those people have to rent. Also, there were no jobs. So, like my daughter, even though she's working, she moved back after college into my house. And she's saving up so she can have her own apartment. But she, like thousands others, 6 years ago, they would have bought their own condominium because they could have gotten 100% financing back in 2005 and 6. So they would come right out of school and go right and buy their own apartment, and the government would give them all the money, or the banks would lend them all the money. That can't happen today. You just cannot get a loan for a house very easily. You need to put down a big deposit. You have to have excellent credit, and most young people today have neither. So all these young people staying with mom and dad, right? And 5 years, 6 years, and for those of you who are moms and dads, there's a time for the kids to go. So after 5 years, we're now saying to our children, please leave. It's time to go and get an apartment. And it's coming at the same time there are jobs. So all these people for 5 years have not had their own place, now are going to get their own place. So what that's done, it's changed who owns what. 6 years ago, 70% of all Americans owned their own home or apartment, and today it's 64%, and the rest are rented. 6%, 6%, but 6% is 20 million people. It's a lot of more people renting apartments, and that is growing every day. Why? We talked about the household formation, the kids that are staying with their parents. It's harder to get a mortgage, and now there's a psychology and fear, because these kids now saw they couldn't get a job. Now they're worried. They don't have that arrogance that young people had 5 or 6 years ago, and so they're more concerned about their future. They're more mobile. They know they need to leave their hometown to follow their job, when 6 years ago they couldn't get another job. So people want to have the opportunity to get up and leave if they have to. So for all these reasons, apartments are looking very good. And the other reason, the last reason, nobody's built any apartments since no one started any new apartments since 2007. So the last apartments were delivered in 2009. So we have year after year after year of all this pent-up demand and no new apartments. So only now new apartments are starting to be built, but it's way behind the demand. There are three types of, there are many types, but we categorize everything. So three types of apartments. We had a focus group, spent a lot of money to decide on the names. Class A, B, and C. And A would be very new, all the schmaltz, very sexy, high ceilings, nice bathrooms, in something that Barack would live in, very, very nice, so happy, only the best for him. So that's usually in the middle of the city, very easy to go to work, etc. Class B would be something very nice but older, maybe 20 years old, but still it's very, very nice. It just has an age on it. They may not have all the internet. They may have some things not as fancy as the A, but still very, very nice. And then Class C, which would be more workforce housing, people who would be teacher assistants, orderlies in hospitals, truck drivers, or young teachers just starting out would look for something that's very cost effective. but it would be older, 1960s, 1970s type of product. It's very important, the differences, and I'll show you why. Because this is a chart that shows you rent growth. And I wish I could have showed you, what this looked like over here. If I went back 2 years, 2009, all three lines would be down here. All three lines would be down here. Because in 2009, people moved back with their families. They moved in together to save money. Rents went down. There was a lot of vacancy, and it caused a lot of problems and disruption in the market. And so rents were very, very low. So rents came from here to up here. But here are the three different classes. A is red, B is blue, C is yellow. And what happened is that the A went first. It went up first because everyone wants the new apartments. And so once they filled up, the rent went up 7% a year for 3 years in a row. Now it's going up a little less. And now Class C and Class B are going up ahead of it. Very important also, I've never seen a graph look so perfect, but rent, the cost of rent is exactly in line with jobs. Exactly in line with jobs. And now jobs are going up, so we're looking for rent to go up. And the other reason that we really are looking at apartments, and I'm looking at apartments so heavily, is this. Interest rates. So if you look at interest rates right here, okay? See this. This is the difference, okay, between the value of the cash flow that investors look for right now that you can get an apartment project for is here, and that's the Treasury bills, the U.S. Treasuries. And never in history, in American history, has that been that big. Sometimes it's even been inverted, but never that big. And as a result, many people, myself included, believe that over time, this may come up a little, but this will come down. And when this comes down, the values actually go up. It's inverted. So we think this is a very, very good time to buy multifamily in general in the United States. See if I can do another one. I picked my city that I live in, Atlanta, just to show you with the national trend. It's a little bigger than we saw before, but you're seeing that the workforce housing, people first coming into the workforce now, they need places to live, and they are paying more rent. This is the rent difference just in the last few months that has taken place in workforce housing. Now this is still going up, it's just going up a little less for the upper class properties, but they've already run up a considerable amount.
Susan, what's the percentage in the vertical, the percentage that you are talking about?
Of rent increase? Well, this is a combination of what we call garden apartments, 2, 3, 4-story, mid-rise, which would be 5 to 8-story, and then high-rise. It's a combination of all of them. High-rise would be mostly, most high-rises are the A class, and they would account for this red line. They would account for this red line. In terms of percentage of units, I actually have never looked at that statistic. But today, there's more construction in the high-rises than there are in the low-rises because they're building more in the core of the cities. But in terms of the percentage, I don't have the answer to that. Lucy, do you know?
In terms of new construction?
In general, the number of apartments in high-rise versus low-rise?
Well, the majority is low-rise.
Mm-hmm.
The majority is low-rise. Maybe 10% is high-rise.
So, I hope that's I don't have the exact answer, but I will look at that. That would be an interesting thing to know. And as you know, I've done a lot of high-rises. Mostly today I'm buying, I myself am buying lower-rise properties. Just to give you an example, this one is, both of these are in Atlanta. This is from 1971. We kind of spruced it up to make it a little modern. and this was from 1984, and very nice projects, both all brick. Both are doing very, very well. I'll just show you a little taste of it. But for you, if you wanted to invest in the United States, and I'm going to talk about how you invest in a moment, but there are things that you have to consider. And when I talk to Israelis all the time, and I'll speak to them about investing in the United States one-on-one, I'll look after I'm done and I say, now I know you have 3 questions. They say, how do you know I have 3 questions? I said, I know. Israelis always have the same 3 questions. And what are the 3 questions? I said, well, the first one is, how am I stealing from you? So, and then it was like, how did you know? So I said, well, that's why it's important. I said that, no, left, so you think that, I know that. Transparency. Being able to see through and know exactly what you're investing in, and nobody's hiding anything. And it's very important. It's not so easy, by the way, to find that. Make sure you get reporting, you know what's going on. You want to time the market, buy low, sell high. I always laugh to joke to my young people working for me that we've actually dusted off an old business plan from the library. We're going to buy low and sell high. We haven't done that in a generation. Let's try it. It's new. Your parents loved it and worked for them. We're going to do it now again. Also, what is your risk tolerance? Are you willing to lose all your money? And if you want to risk it, are you going to get the reward for it? Is there enough profit potential to justify the risk? And sometimes people jump in too quickly thinking that something looks good and they risk their money unnecessarily. So it's important to be very careful and thoughtful. And know that, are you looking for entrepreneurial returns? Are you looking for really big returns? Or do you want more like a bond return, something that's much safer? So something to think about. When we buy, we look for properties that have a story, that we know there's a reason that it's worth, we're buying it cheaper than things around it. Usually it's bank owned, and we also look for things that we can add some value. Can be renovated and upgraded, put in new bathrooms, new kitchens, and whatnot. We look for areas where jobs are being created, and what type of jobs. Are we getting high-tech, high-price jobs? If so, we want to buy better quality apartments. If it's distribution or manufacturing, we look for workforce housing. We always look for location. Doesn't matter the condition, location is more important. We can fix the condition. And we also like to buy where the big money is not buying right now. I find that Wall Street is, sorry for the Wall Street people, but Wall Street sometimes follows the herd. They're a little slow, and once they get going, they really drive up the market. So I like to be a step ahead of them. Where are they not investing? That's where I want to go. Just to show you a little idea, I talked about adding some value. This is a project we bought. It's 1981 construction, and you can see this is the before and after. This is the kitchen before. This is the kitchen after, and we spent about $5,000 on that apartment to fix it, and we got a $150 rent increase, which is about $700-800 a month. So a year, which about $1,500-1,800 a year. So we got like a 25% return on our investment, and that's what we kind of look for. And then for you, if you were going to invest in the U.S., there are 4 ways, more than 4, but 4 basic ways to buy into a REIT, which is a sort of a public offering. There are also public companies that are not REITs that also invest in real estate, and you're buying shares in a public company. You don't have a lot of control, but there's transparency, you get reports, and 90% of all the revenue has to go to you as a shareholder. So the REIT can't decide, we're going to hold the capital for reserves, we're going to hold the capital to buy something new. They have to give you 90% of all the profits on a continuous basis. So there's some good things about a REIT. The bad things, though, they can issue more stock anytime they want, and they can keep getting bigger. And it's not like you're buying one entity at one capitalization. They can increase their capital anytime they want, which could dilute you. You could, I mentioned buying into a fund. There are companies, private companies and public companies, that set up separate funds to buy certain types of real estate. It could be office, industrial, multifamily, and they'll go out and sell shares in that fund, and they'll give you the kind of investments that they'll make in that fund, but they're very general. It could be one, we're going to buy only income producing, we're going to buy stuff that we can develop, we're going to buy office. They can list what it is. It could be several things, and you invest in that fund and trust in that fund manager to put out the money wisely. They're not necessarily the developer. They're just simply a fund company that then finds a developer and lends them or invests money in a particular project or projects. Some developers, like me, but not me, but like me, will create their own funds just for themselves. And you may see that from time to time, where development companies from the U.S. will come here and say, invest $100,000, $200,000, $50,000 in my fund, and trust me, I'm going to go put out the money in this type of projects, and they'll go and do that. And the developers like it because they then know they have the money, they can make a bid on the property and negotiate from strength. The bad news is that they know they have the money and then they want to put it out. So they may not be as wise in what they put the money into, but it's a good vehicle for a lot of people because it spreads the risk among a lot of different properties. Another way, the way I do it is I do it on an individual property, and then I'll issue shares in a company that just buys that property or 2 or 3 properties together. And you know exactly what you're buying, what the risk is, the location, etc. And the final way, and the way that I hear from a lot of Israelis they like to invest, is to actually buy an individual house or a condominium or a couple of them because they want to own them and feel that it's theirs, as opposed to owning a share certificate in any of the other 3 investment vehicles. Tell just a quick story. I too wanted to buy houses. I saw the prices go down. So in 2009, I bought a few houses in a sort of a transitional area in Atlanta. And a few weeks later, the police came to my office and handed me a citation. And I said, "What's this for?" And they said, "You're maintaining the house. You're not maintaining your house, and we're giving you a ticket for, you have to go to court. You got to pay a fine and fix your house up." I said, "The house is perfect. I just renovated it. I put in new appliances. It's very pretty." They said, "You better go down and look at your house." So I went down to look at my house, and someone came with a chainsaw and cut this whole side of the house out to get in to steal the appliances and the copper piping and wiring. So because I had the whole side of the house was missing, and I said, "That's the end of my house buying days," and I sold all my houses. I said it's too difficult. So it is hard. There's a maintenance management problem. My office was 4 miles away. You're 5,000 miles away. It's a little harder to manage and maintain it. The police may not find you here, but you still have those kind of problems. But there are a lot of Israelis who are putting together groups here to buy houses, and it's been it can be a good business. That is going away now because hedge funds and private equity have got the same idea, and then they put together billion-dollar funds and are buying 1,000 houses, 2,000 houses, 5,000 houses at a time, and have really bid the prices up quite a lot. So it's hard to find, probably in good markets, houses that are a good value today compared to, say, 2 years ago. So it's a little more difficult, but again, you touch it, you own it, and you have control over it. And sometimes that's very good, and in my case, it could be very, very bad. So just something to consider. And just want to conclude and say that we believe that if you have the right knowledge, experience, and team, that this is the best time to buy apartments in the United States. There's still a lot of good values. There's great cash flow. Cash flow is increasing, so we think that's really important. And we think more and more people are going to be going into apartments because they have to. They need a place to live, and they can't buy a house. And now equity, the big capital providers are starting to buy apartments a lot, and we're seeing the prices go up very quickly. But we still think there's a very, very big way to go in terms of value. And then the part that my team likes a lot, that we go into a bank-owned, bank foreclosed apartments and we go and fix it up. That I had a case on Christmas. Just before Christmas, we bought a property and we were doing a major renovation immediately. We sent in dozens of people cleaning it up and providing a lot of the basics that weren't being provided. And a lady comes out of the apartment and hugs my construction manager and says, "You just gave me the best Christmas present ever. Thank you so much." And when you see that and my employees cry, it really means something to them that we know that we're really providing something clean, safe, and improving our community. So it's something that we really enjoy, buying some of these older properties and fixing them and making an impact, not just on these individual lives, but the whole neighborhood and what have you. So we kind of like that. I come from Brooklyn, and it's kind of a poor neighborhood, and it's very personal to me to be able to do something that really helps individuals and the community. So anyway, that's just about a little bit about us, a little bit about the apartment market in the United States, and I don't know if I don't have a funny line to end this with, so I'll sort of just let you tell me how to do my business and open it up to any questions. See anything I missed that you think I should discuss?
No, you did very well.
No? Well, that's the last person who'll say that today. Any questions, please? I have a son who's single, so if you want to know, I'm open. He's 26. He's very good looking, and he has a good financial statement. So, yes, sir.
Now, still a question, which I repeat. Okay, we invest 100,000, $250,000, $1 million in one project.
Yes.
How do we get out of it?
Well, great. In the United States,
It's a way. You can sell the shares.
That's right. When it's a REIT, you can sell. It's public, and it can go down, it can go up, but you can.
If you buy an apartment block with your friends, the sale is block. What happens here?
Well, there are two ways. There are two ways to exit. We call it exit, to be able to get out of an investment. The first is to sell it. It's the easiest way, and we like to go in, we fix it up, we raise the rents. You create a cash flow that has value, that's capitalized on the markets, and that capital, we saw that spread is getting tighter, so it's going to sell for more. So selling it is one way. The other way, and a way we're doing about half the time, is we're financing out the equity. So for example, we bought a property 14 months ago, and on December 30th in 2011, and we put in $8.8 million, of which about $3.3 million was equity, that's your money, and the rest was the bank. We're refinancing it today for $10.4 million. So we're able to now get out all of your equity, have a profit, and it's all tax-free because you're not selling it. So you're just borrowing the money, so you don't pay any tax on that, and then you still own it, and the interest rate is 2% lower than the bridge loan we originally got. The amortization, the principal payments are 35 years instead of 25, so we're actually paying almost the same amount a month, but now all our money is out, and we've gotten some return, and we still have the opportunity to make more money later. So that's another way. That was not available 2 years ago or so, and now, of course, there's so much more liquidity, it's easier to get a loan. So that's a second way to do it. Now, the bigger question is, who makes that decision? So if you're buying your own house, you have just 5 or 6 friends, you can sit around and have coffee and make the decision. But if you're investing with someone else, you don't have that control. And that is a risk. And that's why you have to know who you're dealing with, and there's transparency and there's also communication. There is a provision in the United States for the investors to override the decision of the enforcer sale. And you never want to do that because that creates disharmony, but that is a risk, and I'm glad you asked that question. But there are several ways to exit. One of the things, depending on how it's structured, to give some comfort to that decision, is that the developer or sponsor makes his money on the exit, because after you get a certain return, they get extra. So they want to have that triggering event for them to make their profit. So if that's any comfort to you, but that is a risk. That is lack of liquidity of your investment. You can't just go out in the open market and sell it. You have to be willing to wait 1, 2, 3 years, or whatever the developer is suggesting when they talk to you about it. So it is a very important question, and I'm glad you asked it. Yes, sir.
Usually, when a category C apartment has the best return on investment, it's an indication that the economy is good. However, the U.S. economy is still struggling and the unemployment is high, so how it's going together?
Well, very good question, and I've answered part of it, but I'm going to add something to it. Nobody goes out and builds C-class apartments. Nobody builds them. You see in Tel Aviv, do you see anyone building, bad housing? No, everybody's building big, high-rise, pretty, very nice, right? Everyone builds Class A. So there's no new Class C that's been built. In fact, because they've gotten older, and because capital was starved for the last 5 years, many have just closed up and been torn down. So there's actually less supply of Class C apartments than there were 5 years ago. The second thing is that it's cheap. It's cheaper. So a lot of people are moving down to Class C from Class B or Class A to Class C because it's a value and they can afford it. Because right now the rent difference between A and C or B and C, very, very big. Could be in Atlanta, Class A could be $1,500 to $2,000 a month, and Class C could be $500 a month. And you could be blocks away from each other. So people, if it's clean, if it's safe, it's well kept, it's still old, but people are going to that because it's a value. But there is less of it. It is less expensive, and also as a buyer, it's much, much cheaper than to buy that. So that's why there's right now the returns are the best for me, because I'm buying it cheaper than even the cash flow would indicate, and there are more and more people that can afford that rather than the more expensive apartments.
Norman, last question, if I may. Further to the question that was asked from the gentleman here, if an investor that invested with you in a deal went out before we sell, would you be able to assist such an investor to find a buyer or to trade the unit?
Oh, yeah, there is a market, just because it's not public, there is a market for that. Obviously, the market would start with your other investors. So if all 50 of you would bought a unit or a share in a project, and someone for personal reasons needed, not because the project's not doing well, that's different, but just your personal situation, your daughter's getting married, you need to pay for a wedding, I hope it's something like that, and you need the money, how do you get the money? It's not easy to borrow against that, but you can go to the other 50 people who invested and try, and so there is a market to it. And then in my case, we buy it back, so it's not, we'll do that all the time. I'm not here to sell a meat, by the way, we're fully funded, but just in general, there is a market, it's just pretty thin. So you want to ask about that question before you make an investment. But there is some market for it, it's just a thinner market. But thank you so much. Nobody,